Hey guys, welcome back to the channel and of course to another episode of the 365 Days of Forex series. In this video I'll be introducing you to the different types of moving averages and how you can use moving averages to increase the number of confidence factors that you have when taking a position. Also guys, if you stick around until the end of the video, I'm going to be giving away a moving average crossover trading strategy that you can start using in the markets today. So without further ado guys, let's get into today's video. Moving averages are simple technical analysis tools that are used by traders to smooth out historic price data, which then creates a constantly updating average price. The average is taken over a specific period of time, and this is why any period of time can be used that the trader wants. It might be a 10-second moving average, it might be a 10-day moving average, it might be a 10-year moving average. Regardless of which one you're using in the system, you need to decide which moving average you want to use. There's a few different types of moving averages, and they'll all tell a slightly different story of what price has done historically. Therefore, it's key to know each of their strengths and differences. As I mentioned just before, there are a few types of moving averages, with the common being the simple moving average, or as it's sometimes referred to as the SMA for short. As well as this, there's also the exponential moving average, or EMA for short. The SMA is calculated by taking the sum of the given values of price and dividing it by the number of periods that you have looked at. For example, if you have a 3-period SMA and the prices during the last 3 periods were 4, 3 and 5, we would use the sum of these prices, which gives us 12, and then we would divide this number by the number of periods, which is 3. This would result in the SMA for these periods being 4. This means that during the last 3 periods, our simple moving average would tell us that on average the price was 4. The other type of moving average is the exponential moving average. This works similarly to an SMA in regards to the average being taken over a set period of time. However, the EMA differs when calculating the value of price for the period of time that the EMA was sampling. Due to the EMA weighting more recent price higher than more historic price, it allows the average to be a bit more accurate in relation to what price is doing currently. This means that the EMA is more responsive as an indicator to price, and this is why most traders will prefer using the EMA over the SMA. So to quickly recap, SMA is a slightly slower moving average, whilst an EMA is a slightly quicker moving average. When traders use moving averages, I typically see them being used for 3 reasons: variable support and resistance, directional bias, or in a moving average crossover system. Let's now consider each of these in a bit more detail. The idea of variable support and resistance stems from traders using pullbacks to enter in the direction of a dominant trend. A moving average allows an easy place to quantify your risk when entering a position like this, and so if lots of people are using the moving averages to enter their positions, they act like support and resistance. It must be noted though that like horizontal support and resistance, these levels won't always hold, and sometimes price will just go through them, so don't think that you've just found the holy grail for support and resistance. When I first started trading, or at least trading properly and not just using the classic "this looks like it's going down so I'm going to sell" method, I would use the 50 EMA as a level of dynamic support and resistance for my trading, and I would look for rejections or retests to this 50 EMA as a confluence on the hourly time frame when I was looking for my personal trading entries. Now I'm sure that some of the more inquisitive viewers amongst us will probably be wondering why I chose to use the 50 EMA and not say the 40 EMA, 45 EMA, 55 EMA or 60 EMA. Well, this is actually down to some research that I did when looking on Google Scholar, which is actually a great research tool to use actual educational papers. I was looking for the different lengths and research around EMAs that would be best suited to trading on the daily time frame, and more specifically, that were reactive enough for hourly entries. For this style of trading, I knew I'd need a relatively slow EMA that would factor in price action that was impacting the higher time frames where the big dogs do business, but also one that was reactive enough on the lower time frames where it would place a stop loss that wasn't the size of a small house. So let's take a look at establishing directional bias using moving averages. This one is relatively easy to spot, but I don't see that many traders are using it in their systems. You can use moving averages as a tool for directional bias. For example, if price is moving above the moving average, like on the right, you can clearly see that we're currently in an uptrend. So you should be looking for long entries only. The same logic follows with the moving average being above price, like again what you can see on the right. as this suggests we're in a downtrend and we should only be looking for sell trades. Remember, we always want to follow the trend rather than pick tops and bottoms. One of the more frequent questions about moving averages as a directional bias is what happens when price is trading through the moving average. In this scenario, I'd probably suggest that you have no directional bias, so you probably want to use a strategy that works well in ranging markets. Next, let's look at a moving average crossover strategy on TradingView. A moving average crossover is usually used as the basis of a trading strategy. Let's look at an example here where we can see the 10 EMA crossing the 20 EMA in an upwards direction. What this is actually suggesting is that momentum has swung to the upside, so you should now look to enter a long position. Many people disregard moving average crossover strategies as useless because they lag and respond only after prices start to move. But personally, I've had really good success with some of these systems in the past, and in fact, one of my most recent strategies is based on a moving average crossover. The reason that I didn't use something such as a 200 EMA or SMA crossover along with a 50 EMA when I was trading was that it's simply down to personal preference. And of course, with all of my decisions when it comes to trading, it's backed up by data that I've gathered from both forward and backtesting. I've generally found that the crossover techniques work well in the markets when they're trending perfectly, but at a time making this video, we're recovering from a global pandemic, as well as many other things. There is no way to get around this and only trade generally appreciating assets such as indices, and maybe if you guys smash that like button and comment below, I can go into more detail about that in the following videos. So guys, that about wraps this episode up. And in fact, if you've missed out on any of the episodes that have absolute knowledge bombs, which we've already uploaded to the channel, maybe you should check them out too. Knowledge! Remember, if you liked the video, then hit that like button. If you want to be part of the ever-growing FXE family, then subscribe so you can join the party. So with all that out of the way, guys, cheers, and I will see you in the next one.